Awesome. Welcome to our latest offering, the Barcelona on Chisholm Trail. We are on-site equity, excited to be partnering with Tri-City Equity Group. We can go ahead and get started. Before we get started, please take a minute to read the disclaimer. As always, our investments, our past performance don't guarantee anything in the future. This is a 506B offering. So you need to have a pre-existing relationship with Aaron or myself or one of the sponsors, especially as an unaccredited investor. If you're interested in learning more for future investments, please reach out to us. You can talk with Aaron and I at any time. Happy to grab a coffee or do a Zoom call. But yeah, please read through this and we'll get going. So we are on-site equity. I'm Devin McNichol and here with my best buddy, my best friend and business partner.
Yeah, I'm Aaron Burnback. We have been in real estate sales for 8 years. We've been in the multifamily world for I think 6 or 7 at this point. We have 551 units that we have in our portfolio. We run a real estate sales team in Los Angeles. We're in the top 1.5% of realtors. So real estate is what we do, and we have a good time doing it.
And I just want to add as well, this is our third time partnering with Tri-City Equity. Super excited to be partnering with them again. We'll chat about some of the other deals that we're on with them a bit later, but we can introduce them now as well. Here we go.
Thanks, Devin. So I'm Vince Gethings, co-founder and asset manager of Tri-City Equity Group. Sitting next to me is John Harris. He's the president of BlackSand Property Management. Say hi.
Hey, how's it going, y'all?
Also on the screen here is Duke Ong. He's co-founder of Tri-City Equity Group. He serves as the investor relations. Next to him is Duran Bethea. He's one of the key principals and director of acquisitions for Tri-City. And then the last person on there is Jim Bisley. He's a key principal as well for Tri-City.
Awesome. We can just go high level over some investment highlights here. Aaron, if you want to kick it off.
For sure. One of the things that we love most about this deal, and we'll talk more about all of these, but the entry point, we're getting this $11.5 million below the last time it transacted, which is significantly below what it would take to actually build this asset today.
And we love the location. One of the things, we always look for is being in a metro that we love with job growth and population growth and the area medium income, which we'll talk about. Also, as you can see from the photo here, it's right by a large freeway, major freeway in the area, which helps with advertising. People can get around the city as well for commuting to jobs. Vince can talk about a little bit about it being stabilized. He'll talk through the business plan a little bit later.
Yep. So the property is fully stabilized, which means it qualifies for agency debt right out the gate. And this is also the second deal we purchased from this seller. We really like that it is stabilized and getting agency debt. A lot of these distressed properties we're seeing in the Sun Belt are not stabilized. So the only way to actually acquire them is to use floating rate bridge debt and a lot of times using recourse debt as well. But because this property is stabilized, we get the best of the best debt terms, which come from Fannie Mae on this deal. So non-recourse, fixed rate, long-term debt right out the gate. And then, yep, go ahead.
No, I was just going to say this is a great opportunity. If you're a real estate professional, like all of us on the call here, we'll be utilizing the 100% bonus depreciation, offering 30, probably closer to 40% a K1 loss on the tax returns for our investors. If you know what that means, fantastic. If you don't, you can chat with us after. Make sure we talk with your CPA about that. And also, yeah, just mentioning again with it being in the Fort Worth area, mentioning that it's in a land moat, which we like to say that you can't build more in this area. It's very, very difficult. There's limited amounts of space. So to reproduce this asset would be very difficult. So like Vince said, buying something that's already stabilized that we can purchase cash flowing and add value to it is phenomenal. And we'll jump into it now. So the deal at a glance, the purchase price is $24.5 million. It's 144 one bedrooms and 104 two bedrooms, which brings us to $99,000 a door, 248 units. As I was talking about, the area medium income is 84,360. That's a key metric that we like to look at before we even begin spending time analyzing a door to really make sure that the residents in the area can afford the rents as they are and can afford them after we renovate units and bring rent up. So we like to see um, 3 times rent for the month, which would bring it about 50,000 a year. So we're well above that comfortably. Also to make sure people can afford it and live and not be really like house poor, but be able to live a good life and want to stay there, which we think helps people stay there and prevents them from moving out. Built in 1982, which we like, 92% occupied at purchase, $130 price per square foot, and Fort Worth, Texas, as we had mentioned. The address also, one of the things we like about these, which we always mention, is you see the address right here. If you go to the Dallas Fort Worth area, you can contact us, reach out to the team, and you could actually go tour the building and say, this is a building that I own, I'm a part of ownership of. We want to set that up with the team before you go, but that is something cool about owning these. It's actual brick and mortar investment.
Hey, Devin, one thing to update, we did just get the final rent roll for closing, and it's they're actually at 95% occupied going into closing.
Oh, fantastic. Even better, 95%.
Mhm.
We'd just like to show here some more photos of the property, which again, feel free to look it up on Google Maps. You can check it out. And we'll talk about the current owner. We'll get into that, but some of the upgrades that he did, you can see it already looks pretty good. Aaron's going to chat over the Metro, DFW Metro, and why we like
Yeah,
this
so
Metro so much.
one of the most important things when we're looking at where we want to buy is looking at the economics of the city and a metro. We look at things like population growth, job growth, diversity of jobs, all of those factors because they all lead to a stable market, which is what we want to focus in. We're not really trying to take chances. We're trying to buy in established areas that we know are going to keep improving. So DFW is one of those metros. There's 8.3 million people that live there. There's 22 Fortune 500 companies that have their headquarters there. It's the fourth largest region in the US. It's the most diverse economy in Texas. It's business friendly, which means there's no state income tax. That leads just on its own to tons of job growth, and population follows the jobs always. It's the fastest growing metro in the US and has been for the last couple of years. And the economic committees in the area are projecting that Fort Worth is actually going to grow faster than Dallas over the next several years to come. I'm going to go to that next one. So Fort Worth overview. So the total population of Fort Worth is just over 1 million residents. It's mostly families, professionals, and there are some retirees that live there as well. Devin touched on the household income, but within a 2 mile radius of this, it's just under 70,000. Within a 5 mile radius, it's just under 74,000. And based on this level of income, the people in the area can easily cover the rent that we're projecting, and still live a comfortable life. And that's really important to us. And then within a 2 mile radius, there are over 25,000 jobs. And if you go even further out, within a 10 mile radius, there are about 355,000 jobs. So it's very, very job centric. People need a place to work, and it's a great environment for that. The diversity of jobs I mentioned earlier is super important. In this immediate area, there's aerospace, there's healthcare, there's manufacturing, there's higher education, there's a plethora of things. Fort Worth itself is growing at about 2% annually. Since 2020, it's grown about 13.7%. Along with all of that, it just has a rich history. For those of you that have been to Fort Worth, you've probably been to the Stockyard. It's one of the most visited places in the country. So when you do go visit the property, it's definitely a stop you have to make. You want to go to the next one there, Dev? Looking at the map, like we said, just seeing where it is positioned to everything around it, you'll notice two major highways that run right past the property, which means tons of like walking traffic or driving traffic. There's all the shopping centers everywhere, so there's lots of walking traffic, which is going to make marketing really easy when we have vacancy. You'll see there's Costco's nearby, stores, malls. It's just super convenient. It's a great place to be. It's easy to get to jobs if you have to drive a long way because you're right along the major thoroughfares in the metro area.
It's three. Yeah, go back one slide real quick. I'll add something to this. So it's actually
Yeah.
three highways. You have 183, Interstate 20, and the Chisholm Trail Tollway. And that's important because that means that this property is the first exit off of those properties, as you can see there in that orange square. And that means that because we're off I-20 and Chisholm Trail, means we can go straight through to the inner cities or the mid cities, which is Irving, Arlington, and all the way through to Dallas. Or so we can capture all of those jobs as well for people commuting to those areas. And then if we go north up the Chisholm Trail, that hooks up and around toward North Dallas. So that will give the North Fort Worth area, give them access to Denton and shoot all the way over to the airport. So having we're right on the crossroads of three major highways gives our residents here huge employment opportunities, not just the 25,000 jobs within, a mile or two, but also easy access to the whole Metroplex.
Which is
Wow.
over 8 million with Dallas, right? So as Vince was saying, I was
Correct.
going to
Yeah.
say that too. Yeah. So opens it up to a lot more people who could live there and a lot of jobs. So people go where the jobs are, which is one of the reasons we love investing here.
Yeah. I'll touch on a couple things on this one. So there are $2 billion, or there have been $2 billion of capital investments made over the last 24 months. And there are 278,000 jobs projected to be come to market by December 2026. One thing I also want to point out on here, there's $840 million that the city of Fort Worth in 2026 voted for a bond to raise that money for the city infrastructure. They're planning on this city growing. They're planning on really investing in the community, which is great. We love to see that. And then the next one will show you just a little bit of like the employer map. So you see Lockheed Martin just a little bit north. It's 8 miles away. There's 23,000 jobs in the metro from them. We have Texas Health, which is 5 miles away, and they have between 25,000 and 29,000 jobs across DFW. UT Southwestern Medical Center has about another 25,000 jobs. DFW Airport, which we mentioned, there's 60,000 jobs brought from that. You have AT&T headquartered, which is 10,000 to 15,000 jobs, and then Southwest Airlines has another 19,000 jobs. And this is just some of them. There are several more, but you can see the easy access and also just the sheer mass of job opportunities that there are in this market.
So thank you, Aaron. I wanted to talk about the elephant in the room of what's happening in the Dallas-Fort Worth area right now. In case you have heard this, we have been following it. Vince has been following it extremely closely, having properties and a property management company there. And as you can see, the numbers have been down, which you might say to yourself, well, why are we looking to buy there? Right now, well, this is a phenomenal time to buy there. We've heard it called and the generational reset in Dallas. Talking to brokers and people familiar, ourselves included, with the area who track it. And this is a phenomenal investment as we'll go through the numbers of how we're able to acquire these assets now at a significant discount. Seeing prices, it's almost like when you sit back and say, man, I should have bought stocks or properties in the 2008, 2009, 2010 when things were down and how far they've come. That's why we're looking at buying this now. So having a boots on the ground team vertically integrated with property management, which we'll get to, allows us to be the industry insiders there and know that this is the time to buy. Also, which we've already touched on, this being stabilized and cash flowing when we buy it to mitigate the risk of that. So we have the financing that we're going to talk about, which is conservative for us and getting a huge discount on the purchase price to take away that risk. So 10 to 15% rents are down across the Metroplex, 20% down with the NOI compression, 12.5% submarket vacancy. You can see that the construction has been declining, but yet there's tons of people still moving there that need a place to live. So the fact that we're able to get this at such a discount at this time is a great opportunity. We're taking advantage of the timing of the market.
A good way, to think about it as well is like the pendulum almost swung too far in the other direction, and now we're catching it there before it kind of swings back to like market equilibrium is how a good analogy I use for it.
Yeah, absolutely. Which brings us right into how this deal can even come about and why it exists. So, in 2023, the current owner purchased the property which we'll get to as well, but purchased the property for around 36 million, put over $1 million of CapEx into the property, and was under contract to sell this at 42 million at the height of the market. The interest rates changed, and that deal canceled, and he was unable to sell at that. So now, with his equity being wiped out, we're buying it for basically what he owed on the property. So his loan is coming due, and we're able to acquire it at 24.5 million, taking advantage of the over $1 million that he put into the property, 42% below where he was going to sell it in 2023. So this explains what I was just talking about on the previous slide of how we're taking advantage of timing the market, his misfortune of having put the $1 million in, and we're going to take advantage of that, add our own CapEx improvements, and set it up to be able to sell. And our exit is actually below that $42 million, which we'll show on a slide later. So this explains a little bit what I was just talking about as well with a graph here. So purchasing it at 36 million in 2021, where he got in, the 42 million being a 2023 LOI price, where he was trying to sell it, and then us taking advantage of it at 24.5 million. That's where we're purchasing it. This is our sale at 39 million, 59% gain. So we're getting it 32% below where the seller bought in 2021, 42% below the peak of where he was trying to sell it. And we're going to create $14.5 million. That's our target, which again is below the 42 million that he already had at the peak of the market. So if we can time it for the next peak, we'll be in really good shape. But being able to buy it cash flowing right now with fixed long-term debt, we feel really good, as you can see, taking advantage of this. Anything you want to add to that, Vince?
No, you definitely nailed it. The big thing is just the 36 million is what his cost base was, and then like you mentioned, he added another million. So he's actually all in for 37, probably closer to 38 million all in is his cost basis, which makes the 42 million at the time. He had a signed LOI to sell the property. Market shifted, interest rates went up, and the buyer ended up walking. But the last point there, that 39 million, even after we acquired the property, we increased rents a little bit, put another 1.5 million in CapEx into it, finishing the build out that he started. We're still not underwriting to exceed the offer he already had in his hand, for the current property condition. So we're going to improve the property and still plan on selling for less than what his last offer was. So it just shows kind of the conservative underwriting that we used. This is another slide. Same story, different slide, but really just going all the way from the 49 million, which is the expected replacement cost for this asset. Again, we're kind of in like an infill type area. So this asset is not easily replaced. We're not worrying about another property popping up next door because as you saw on the map, there's all those malls and highways and stuff surrounding us. So 49 million would be the replacement cost. And then you can kind of see track that, this property, going down to where we're acquiring it at, due to the market there. And like I said, he can't refinance now. So we're grabbing the property up. So about 100% less than the replacement cost.
So these are some of the sales comps that we've used in the area, sold in 2025. And as you can see, $112,000 a door, $137,000 a door, and us getting it at the $99,000 a door. Again, this is the second property Tri-City's purchasing from this seller, and I believe we weren't even the highest offer on this one, but it was the ability and the confidence that they had for us to be able to close is another indication that somebody else was willing to pay more than us on this property. But because they had worked with us before and because they had to sell, they accepted the offer.
Nope, that's exactly right, Devin. We were not the highest offer on this, and I know for sure there was at least one person higher. There might have been two, but there was for sure one person higher than us. We bought a property from this seller last year, and it's operating fine. We'll point it out in a later slide. And he operated it all the way to the end. And that's something that we look for a lot of times when you're dealing with these types of distressed type sales. A lot of times the current owners just kind of drop the keys and walk away. and you don't know what you're actually going to get when you buy, in terms of what's that, has there been any skips? What's the units look like? Because they just stopped managing it. We know this seller. Again, we bought a property from him before, and he operated it just as if he wasn't selling it all the way through the closing. So we know we're going to get a good property with not a ton of delinquency and things like that, and a bunch of vacant units that we don't know about, which is typical when you see a distressed sale. So there's that, and there's also one sales comp that's not a sales comp yet. The property's under contract, but it's actually directly across the highway from Barcelona. It's on the kind of the Costco side. If you remember that slide from the map of where Costco was, that went under contract at 130 a door. So, and it's the same C-class property, 80s construction, C-class workforce housing, went under contract at 130 a door, and it's still under contract today.
That's great.
That is great. So we've chatted about it a bit. Also, what Vince was just saying in terms of the quality of the seller, the slide previously showed 92% occupancy, and as he said, it's gone up to 95%. So that gives us confidence. Even though the team has experience taking over, and we'll talk about some of the benefits of having some vacancies to jump into our construction plan and remodeling. It's nice to see that he's still taking care of it. So this is the debt we've been talking about, getting actual agency debt. You can see the year one DSCR of 1.8. That is amazing. And Aaron will talk about that a little bit later of why that means that the property can cover the loan so well, and it's conservative and it's stabilized as we buy at year one. Vince updated us before the call of getting 5-year term, 2 years interest only payment as we do the construction and remodeling of the units with a 5.4 rate. So this is a great loan, great fixed long-term debt for us as we stabilize this already cash flowing asset. So now we'll get into one of the benefits and why we love partnering with Tri-City in the Dallas area, and having the asset management side as well as the property management side. So I'll let Vince, you jump into this as well as our business plan for operations and some of the remodeling we'll be doing at the property.
All right, sounds good. So, who is Tri-City Equity Group? It's a company we started in 2017 now. We're at the end of 2017. So, we've been doing this for a while. During that time, we've done 18 deals together as a team. We've had 8 full cycle exits, averaging a 33% average annualized return or IRR, 33% return on our exits. We were in 5 different states for a while. And then in 2022, we decided to go all in on one market and we started selling off everything that wasn't in Dallas Fort Worth. So we went all in on Dallas Fort Worth and I moved here. John moved here, who will speak here in a second on the BlackSand side. And we went all in on this market and decided to build up our vertical integration company here, just focusing in the Dallas-Fort Worth market. We've had 0 foreclosures, 0 capital calls, and 0 investor capital lost across our 18 transactions as a team. And most of those deals have been C-class value add. So this is not something new to us, taking over a C-class deal and doing a value add reposition. We've done plenty of them over for me, the last 12 years, I've been doing multifamily. And then next to me here is John Harris. He's the president of the BlackSand Property Management Company. If you want to, talk about the stats of that company.
Yep. So we started 3 years ago, and this has always been on our roadmap to start the company. But here in Dallas, it presented such a opportunity for us to try to do better than our competitors. There's plenty of operators out here in this market that were giving up, turning up keys, and we were fortunate enough to be in a position to capture numerous of these assets at huge discounts. So now the factor was, how do we operate even better? And here within the just 3 years of operations, we've had numerous property management companies on our assets, and we've already been outperforming them. We are nowhere even near where we are planning on getting. We're constantly building our back end team as we speak, and we're only going to get better. So even while since I moved here, Vince moved here, up to that point, we were um, operating with such little manpower behind us. Now that we got full staff, full team, like we're really doing well in this market, and we're super excited to grow.
Right on.
So what is the vertical integration? What does that mean? What does that and what does that look like? So vertical integration means that everything we do is in-house. We look at everything that we touch and figure out how can we eliminate a middleman? How can we eliminate a contractor? We want to control the whole operation from cradle to grave of our business plans, our execution, and the tenant or resident journey. So on the left here, we have in-house execution for property management. That's John and his team. We have construction management in-house. We handle leasing and all marketing efforts in-house, all finance and asset management in-house, as well as direct manufacturer sourcing. And that means we don't go to Lowe's or Home Depot for supplies. When we're doing a heavy value add, like for Barcelona here, we plan on turning 110 units. We're not going to go buy those materials retail. We're going to go directly to China and get them at right off the manufacturer factory floor, and have them custom made for us, shipping containers over to us. My partner, Duran, as you saw on a previous slide, he actually went to China for 3 weeks earlier this year to go identify our manufacturers at their facilities, set up the account so we can start ordering materials directly from them, cabinets, countertops, flooring, light fixtures, plumbing, and everything at huge discounts because we're cutting out two or three middlemen. And now we can, keep all that savings inside and for the benefit of the economics of the business plan. Um, John, you want to talk about the what we're doing for on the right side here for BlackSand?
Yep. So we've been really heavy. Like one of the benefits that we have on being a newer management company is, I came in, learned under Vince all asset management, and so we approached our management company with tech focused, with a new perspective. Management companies in general are slow to move. And where our strength has been is we are out of box thinkers. We're younger, we're more aggressive, and we are wanting to implement very rapidly things that the management companies that we've been dying for them to implement, right? Like these strategies we've been pushing for them for years to implement, and we've been implementing in the matter of months. AI leasing, some of the tools that we're using now aren't new to the industry, but this is yet another tool that we identified what it's got to be 5 years ago, and we've been trying to get the management companies to implement, and they just failed to implement it. So here we are, we're full steam ahead with the AI implementation for our management company, and self showings, virtual tours. This is definitely a thing that we are still implementing, but it's one of the things that we've been pushing our management companies do that it's just been such a long time going. Uh, Fraud protection. We have noticed a huge uptick in DFW alone, and in direct correlation, whenever markets start to suppress, we tend to see fraud increase, we tend to see lawsuits increase. And so what we did was once again implement AI. And so we have AI implemented to scan pay stubs, do background checks to say, hey, is this person actually employed there? And we're using AI to bridge that gap and cut through fraud, right even before they get to come into the asset. This has been a huge game changer, and it's been 6 months since, 6 or 8 months since we implemented this thing, and we've already noticed our collections and economic rising because of this. Deposit alternatives. This is just another tool that is within our tool belt to say, like, if someone doesn't have the ability to come in, we're going to eliminate that barrier to entry and give them other alternatives instead of having to just pay cash. There's surety bonds and things that we're able to implement within the our leasing that has allowed people to come in during market suppression, right? So this is such a huge opportunity. Everybody wants to buy whenever real estate's high. And then everyone is, waiting for a market cool down, but here we are in a market cool down. And now here we are, and it's a great time to buy, but it's hard for people to rent during these periods of time because they too are struggling. So coming in and doing these different um, deposit alternatives, and then we've implemented to bridge the gap since leasing is a little bit slower. We are now full steam ahead on mid to short term rentals in our properties. In fact, we're converting an entire asset into a mid-term to short-term rental asset. And we've been experimenting with this for years, and very successfully. 100% occupancy these things have been going at. So, super exciting times. We're going to be able to bridge the gap with mid to short-term rentals in Barcelona. So we're already analyzing and saying how many units we're going to take. And this is going to allow us to get rent premiums on this asset. And we didn't even underwrite for this, by the way.
Fantastic. I mean, just so everybody's clear, like we've been saying, we feel very comfortable with Barcelona with the long-term tenants. The midterm and short-term is even just an upside on that to get more. It's not like we're turning the 250 units into short-term rentals, but it's a great
No,
opportunity to make some more
it'll be
money.
max. Yeah, it'll be max 10%.
Yep.
So that we're turning 10% of our overall portfolio to the midterm rentals, which is so they're going to be furnished rentals, and they are phenomenal with all the growth that Aaron spoke about earlier in the call. Um, there's so much growth happening here, businesses moving here, expanding here. It's crazy that there's not enough builders, contractors to build like these and we only went over Fort Worth on this call. There's Irving, Arlington, Denton, Dallas, and all the other cities around, 14, 15 cities that make up the Metroplex. All of them are experiencing massive growth, and there's not enough builders. So what happens is a lot of the developers will bring in the construction crews and the builders and the engineers and things like that from other states for a year or two to build these massive new developments. And we have waiting lists at some of our properties for the furnished rentals. And so like John said, we tested it out at a couple of our other assets. It has been phenomenal. So then this past year, at the start of this year, we started rolling it out to the rest of the portfolio.
Speaking of the portfolio,
All
here we
right.
are.
Yeah, so this is our distance analysis. This slide really just showcases that this isn't like some isolated asset out here. This will be our ninth asset here in DFW, and you can see that it's within an hour of any one of our properties. On average, about 30 so minutes, 35 minutes from all of our other assets. Cottages at Bell Station right there, kind of in the center of the page. That is the other asset that we bought off the same seller. So this is located 20 minutes from the last asset we bought from the same seller. And I personally live about 20 minutes away from cottages. So, I'm about 30 or so minutes from Barcelona. John's about 30 minutes. He lives down by the one that says King's Landing down there. So he's about 30 minutes from the asset. So two of the GPs are within 30 minutes of this asset here in the Metroplex. And another thing this also shows is that being vertically integrated, how efficient and agile we can be when, things happen. If we need an extra hand over there for a maintenance or turnover or something like that, or a leasing agent, is sick and calls out, we're not sitting there scrambling with the office being closed or having a maintenance tech out, or like I said, he needs another hand or two. We can just pull them very quickly from another property, and that keeps us moving forward and prevents us from having to hire contracted help as much as possible. So it keeps our expenses down from not having to do that, keeps the office open because we always have kind of a web here of our team that can always cover down any of our assets, if something comes up.
And for our investors in particular, noticing King's Landing, a lot of you will be familiar because that's one of the deals that we invested with Tri-City on. So that one only being 30 minutes away, and some of you are invested in that, and some of you saw the webinar for that one, so you're already familiar with that. So let's jump into the business
There's
plan.
a lot. Yeah, I'll hit the business plan real quick. So there's a lot on this slide. I'm not, you can pause and read it. I'll kind of go through it real quick. So, we talked about that. So I break my business plans down into three phases. You have the acquisition phase, reposition phase, and then optimization and harvest phase. So during the acquisition phase, that's the first 3 months of a closing. So when we take over the property, we'll get the team in there, maintenance in there, immediately start kicking off any CapEx issues that were cited during due diligence. So any life or safety issues, any pending code violations and stuff like that that the city wants done, we knock all that out right away. Then we do 100% unit walk again. I know we did one during due diligence, but we'll do another 100% unit walk. And we're looking for anything of did anybody skip, things like that. Looking for making sure that all the pets are documented and things like that. Any maintenance issues that we find inside units, like leaks that were not reported, and we start triaging that, putting in work tickets, and taking care of them. We also start our we call our resident journey. That's getting to know each of the residents, both having them come in the office. We'll throw some resident events, get to know them, get to build rapport with them very, very quickly because that will transition into lease renewals, paying on time, and things like that. Once they see, that we actually care about where they live and their homes and things like that. So that's going to be acquisition phase. And then we go and start implementing all of our systems and processes, rubs and whatnot, transferring everything over. Then after the first 3 months, we'll start moving into the reposition phase. This is where the heavy lift is going to be. This is where the reposition on a value add reposition comes in. So generally that's going to last up to a year. And that's where we're going to execute the bulk of our 1.5 million CapEx program. We plan on doing 110 interior units, a bunch of stuff on the outside we have a bunch of stuff we have to do like gutters and trim trees down and things like that, fix some lighting, parking lot issues. But mostly it's going to be the interior renovations of finishing what the current owner has already done. He did about 27 to 30 units already renovated. So when we do our 110, that will put this property about 50% renovated and then the other 50% classic. We want to do that. It might sound counterintuitive, well, why don't we just do all the units to get all the rent premium? We've done that and it actually kind of is not good. And the reason is if we renovate all the units, then we don't actually leave some meat on the bone for the next person. So as I'm building a business plan, I start by thinking, who am I going to sell this property to in 3 to 5 years? And what kind of property did they want that would make an attractive purchase for the next person? And then once I think about that, I get with a broker, validate my thesis, and then I build my business plan backwards from there. I'm saying, okay, so we're going to capture this amount of upside and we're going to leave this much for the next group. That way we can have a quick, attractive sale on the next round here when we go to sell it. So that's where the 110 units comes from and why we're not doing all 248 units. So about 50% of the property will be renovated and we'll be able to prove out the rent premiums on those units, have a good blended increased rents, and then there'll still be plenty of upside for the next group to jump in and be attracted to the deal. Once we start hitting close to our NOI target, so I have different thresholds and milestones for increasing the net operating income. And once we start getting close to that number, normally that happens around the 3 year mark. I will bring the broker back out, show them everything we've done at the property, and have them start doing a broker opinion of value, a BOV, and see how close their BOV is to our target exit price. And then if we're close, we might start the sale process at that time at year 3. If we're still have some ways to go, then I'll work with them on that last kind of 10-20% of the business plan to really fine tune it to what would make an attractive deal. What does the rents need to be at? What does the expenses need to be at? What does occupancies and unit conditions need to be at? So that last 10 to 20% is working really close with the broker because they're going to know all the buyers and what they're looking for. So I really fine tune that last round and third base to home. I work close with the broker to get this property positioned to where it'd make attractive sale. And that process usually starts in year 3 and will continue usually every quarter, every 6 months, all the way through to year 5 if needed. But at any point, I'm meeting with the brokers. They say, "Yep, you're in the window. Let's list the property and we'll sell." So that's why this isn't just a 5-year hold. We usually start around year three, and any point between year three and year five is when we'll target to transact with the focus of optimizing the investor's IRR. All right, so on this slide here, this is kind of broken up into three sections. So on the left side here just shows our sources and uses of, or our uses rather, of our CapEx budget. So 870,000 on the interior, 587 on the exterior, with a 73,000 on the contingency, and that's where the 1.5 in total CapEx comes from. On the bottom, it has the execution timeline. It's kind of hard to see that there's another slide that shows it a little bit better, so we're going to wait till that one. And then as we move over to the right side here, John, do you want to take that and talk about what we do for our rent comps using like ALN and things like that to, really make sure that we know that our target rents are good?
Yep. So we and I do this every week. So I have the property managers actually go boots on the ground, that they need to go out and rent comp themselves, but we use analytics and a really good source here, and it's a local company founded, created for decades now at this point. And their tools are so good that they go around and call all these apartments across DFW, and they have a really good system of analyzing, what are rents, what are effective rents, and the biggest thing is the effective rent is, yeah, here's their asking price, but what are they actually giving away in concessions? And so you get to see these different tools. And what on this business plan, I think you just did what, no higher than like $50 from um, where they're doing now for rent.
What's that?
From where the current rents are,
Mhm.
our business plan's only showing like $50 increases typically.
Yeah, so we have on here the blended at 100, 111 a door is our blended um, increase for this property is what we're shooting for, and that's actually less than, so because the market is 10 to 15% lower on rents. This property is another like 5 to 10% under that. So our $110 a door increase is really just bringing us up to where the market is today, not even where it was last year or the year before. So there's still a whole lot of upside that we didn't even account for. We're just projecting to bring this property up to today's market in 2022 because they're even under that.
I'm
Yep.
glad you said
And in
that.
short,
Yeah,
how that affects the rents is we're not even having to go on me on the management side and operations. We're not even having to go very aggressive on our rent increases to get what he's outlining.
Yep.
yeah, that's what I was going to say. Based on what I said earlier of it being a amazing time to buy in the Dallas area, and us putting the rents like where they are now or a little bit below they are now, not putting in our underwriting where they were or where we think they could go. That's a crucial point for people to notice. I also want to just touch base on a few things that Vince and I have discussed before. When looking at the information on the left there, to point out that the previous owner, we had mentioned the money that he put into the building, but the current condition, the roofs being in actually pretty good shape, the property having PVC plumbing. I think Vince, you said like one half of the HVAC systems have been replaced. So part of that
Correct.
exterior and common areas budget is like $175,000 for HVACs, which we probably won't need all of. Um, and then the one thing that we will be doing is converting the electric panels from the Federal Pacific to modern electric panels. But one thing that you had mentioned was buying those directly from China, the panels themselves, to save money on that. And then I think you had mentioned potentially hiring an electrician to bring on board, as you had said, to like cut out the need to hire an electrician to save money as well on that. Is that right?
Correct. Yeah, one of our other partners in one of our other companies, he's actually a licensed MEP electrician, and he just moved here from Hawaii and already has his Texas electrician's license. So he is fully able to, get the permits and sign off on that and hire a couple of guys under him. So they'll be, kind of just at cost. to go and do this work. So we're not going to have to pay some general contractor a ton of money to go and do the panel since we can do that in-house as well.
Yeah, it's great. So even though we're allocating $1.5 million of CapEx, like we had mentioned a couple times, taking advantage of the money that the seller put into it with the newer roof and the plumbing. I know I just mentioned it, but just one more reason why we like this deal. These are some of the rent comps in the
All right.
area that we use when analyzing. So you guys can take a look and look through there. But that, what John and Vince both talked about on the last slide to talk about where we are and where some of the other properties in the area are to make sure that we're analyzing this conservatively and that renters are looking at our building and other buildings in the area and saying, okay, yeah, we want to rent yours.
All right, this is that one slide I want to show you. On the previous slide, I had that small table at the bottom. This is a much better way to look at it. So what we're looking at it is the one on the x-axis is the month of takeover, or the month essentially the month after takeover, and then 12 months after that. And what we do to build this is that we actually do a lease audit and a lease expiration audit. And then we map out all of the leases that are expiring and when they're expiring by the month, and then apply our typical turnover rate for an asset like this. Because we're at 95% occupied, it's like, well, how are you going to renovate 110 units if the property is 95% occupied? So the way we do it is through this chart here of we know when every lease is going to expire. We plot them out. So we can, go in and expect not all of those units are going to move out. And then when they move out, we can go in, renovate them. And that also gives us opportunities to transfer residents to other units to get those units so we can renovate them out. And then we'll have our typical attrition through things like evictions and just notice to vacate and skips and things like that throughout ownership that just normally typically happen. And then we'll grab all those units and renovate those as well. So rather than just say we're going to do 110 units, this is actually how and when we expect to do them, with our highest month coming around Q2 next year. As we ramp up there, kind of at the peak of that curve, there is when most of those units will be expected to turn over because there's a high concentration of leases expiring during that time.
And there's also something that importantly touched on there, which is when somebody's lease becomes expired, we're not necessarily kicking them out. We're the good tenants who we figure out through the first couple of months of ownership as who's paying on time, who do we like, who's good for the community. We offer them a renovated unit in the same building to hopefully keep them, but give them an upgrade, and then they stay and we get another unit that's free. And that's a good way to keep our vacancy down while we do that. Go ahead, next slide, Devin. So this is the ProForma operating statement. You can look at this in depth later, but basically, if you look along the bottom, the net operating income goes from about 1.5 million in year one all the way to 2.1 million in year five. And that happens because if you look at the gross income, which is a little bit further above that, we're taking it from 3.5 million in year one to 4.4 million in year five, while maintaining the expenses and lowering them as they compare to our gross income. So right now there's about a 58% expense ratio, and our goal is to drop it to around 52%.
All right.
And that sorry, just one thing on that. And that 52%, we here in BlackSand in our first few years, we've actually gotten properties down in the 40s. So we've been able to effectively do this, even in some of the toughest markets. So 52% is definitely something very achievable for BlackSand.
Perfect.
Thanks. Okay, so getting into probably what you're here to see is how you get paid, how investors get paid on the property. So there's five different share classes, as you can see on the screen. A1 is for someone who's looking, and if you have questions after, feel free to contact Aaron or I on this. No problem. We can go through in detail to talk about which class you might fit into. But A1 is for someone looking for more of a fixed income. So you get an 8% preferred return. minimum $100,000 investment. And you get paid that 8% starting right away. In the first month of ownership, you get paid monthly. But there is no upside. So you're taking the 8% a year, but you're not getting any of the upside of the sale or the refinance. The A2 investors, which a lot of you I think would want to do and fall under, I think Aaron and myself will fall under that as well, is the 70% of remaining profits up to 20% IRR, and then it's split 50-50. The A3 is a 5% return, preferred return, but it's a $500,000 minimum investment, and then they get 70% of profits up to 20% IRR, and then 50-50 after. The A4 is a 5% preferred return and 80% of the remaining profits with a $1 million investment. And then the A5 is for any of investors who are looking to invest with a self-directed IRA, a retirement account. They get a 1% preferred return and the upside. So if you're looking in the retirement account, make sure to reach out to us because you could qualify for that as well. The returns on the right side are projected with the conservative underwriting we've been talking about, 16 to 18% IRR, 2 to 2.25x equity multiple, 18 to 21% average annual return, and then 5 to 7% stabilized cash on cash with a minimum investment of $100,000 and an estimated hold period of 5 years. One thing we'll get to as well, but this obviously, as we're saying, is a conservative underwriting with the IRR. We'll show you some of the IRRs and average annual returns from some of the other deals Tri-City has done, including one that we did with them and exited a little bit later on. This is, again, going into the investment overview of the capital stack. So the senior debt is the loan there at the bottom. Then it's that A1 share I mentioned with the 8%. Then the A2, 3, 4, and 5, 70 to 80% profit split, and the GP co-invest there at the top. As we cash flow on the right here, I'll talk about the deal structure. So we have the owner of the property, the LLC, which comprised of the 70% limited partners in an LLC, as well as the 30% management LLC. As we cash flow during the hold, the A1 investors and the A3, 4, and 5 will have the preferred return. So those will get paid out. And then after that, it will be split 70-30, up to a 20% IRR, and then 50% after that. Same thing on the refinance. As you can see, it'll be return of capital, and then it will be the 70-30, both for the refinance and the sale. So the A1 investors always get their 8% preferred return first, and then the A3, 4, and 5 get their preferred return and return of capital, and the A2 gets their return of capital before the 70-30 split. This is a sample investment. So that fixed income investor I was mentioning before, with the A1, if you're looking for just a 8% preferred return for the year, you put the 100,000 in and you get 8% in year 1, 8% year 2, 8% year 3, 8% year 4. In year 5, you get your $100,000 back along with that 8%. And that is paid monthly. So again, if this is someone who's fixed income and you're looking for 8% a year on your money, this is a great option for you. The A2 investor, which I mentioned, I think most of you fall into, you also get some cash flow year run. So as Vince had explained, in year 1, where we're renovating the units, there will be some vacancy, which we expect. But still, because we're buying a cash flowing, we anticipate towards the end of year 1 of ownership, we'll kick that off and you'll get about 3.3%. Year 2, that will boost to almost 7%. Year 3, going to 8%. Year 4, we lose the interest only, so it'll drop down to 6.5%. But as we continue to grow, it'll get back to 7.5%. The big thing that you'll see here, though, is the proceeds from the sale. So you'll get your initial capital back of the 100,000, and then the proceeds of the sale, 67,000. So this brings us, as you can see on the very bottom there, total capital return plus cash flow plus sale is 200,000. So over 2x equity multiple.
A couple things to add real quick on that is the GP co-invest on this is the initial slide had 10%. Since then, we've doubled that. So we're going to be putting about 20% of the entire equity is coming from the GP team. So about $2 million is coming from the GPs invest in this one. of our own capital.
So that's really good for people to know as well and understand of the GPs having skin in the game of $2 million. This is a similar projected returns for someone who might be interested in putting 250,000. We just spelled it out so you could see that as well. You can take a look at that.
And then one of the important things that we always talk about with this is the tax benefits, cost segregation, and bonus depreciation. So the property value for depreciation is around 20.8 million. We're estimating about 6.25 million in accelerated depreciation year one, which gives about 4.37 million for the LPs. It's about 70% of the total. So what that actually looks like for you if you invest $100,000 is that you should get about a $41,000 passive loss. Now, please consult with your CPA. We are not CPAs. Everybody's tax situation is different. So if you have questions about that, let us know and we can talk with your CPA about that as well.
But this is a huge benefit. If you know about it, fantastic. If you don't know about it, reach out to us and we can help explain. And again, talk with your tax professionals. But this is a huge reason a lot of people love investing in apartment buildings, why high net worth people buy them, and why I'm sure you're interested in watching this and interested in investing.
And then one of the last things we'll talk about is the risk analysis. So we talked about it a little bit earlier, but if you look on the left there, you see like the occupancy stress test. So our break-even occupancy right when we step in is 74.1%. As we talked about earlier, we're currently at 95%. Year one, our break-even is 68%. Year two, it's 62%. So you can see we are significantly above that in occupancy, which is really helping us mitigate the risk with this asset. The other thing on the right side is a sensitivity analysis. So this is actually looking at the IRR over a 5-year hold. So on the left side, you'll see cap rates as they fluctuate up and down. As if the cap rates are increasing year five, and we're approaching I think the top of the one says we're approaching a 5.95% cap rate, the IRR would look at like 13.7%. And then if things go better in the market, which we're anticipating the market rebounding and getting better, cap rates compress. And if we go all the way down to the bottom there, if the cap rate is around a 4.45%, you'll end up with about a 22% IRR on your return.
All right, so this is our current portfolio in the market. John here can speak to any updates or anything going on any of the properties since we built this slide.
Yep. So King's Landing, we're actually above 95%. We actually only have 2 vacancies right now that we're going to actually turn into Airbnbs, mind you. So we also have Little Creek. We're about 88 right now. Little Creek's just a unique market because of the judge out there is very pro renter, so we wind up getting people staying longer, and so we're back and forth kind of with navigating that. But that's why BlackSand's on site finally to get the job done right, and we're going to do it. Cottages, we're actually 96%. This was the asset that we'd taken over, and one thing to highlight on here is this was an asset we've taken over from this current seller. And same blueprint, same plan. They wanted to do the best that they can with driving traffic in. There's always some fluctuations whenever taking over, but it had dipped, and we had gotten it stabilized in about 6 months from takeover. 6 to 9 months. And any management company that we've had do this, we were easy 12 to 18 months trying to get the management company to do the thing. So just to identify the speed that BlackSand's able to execute on, here we are with cottages, same type of strategy, same seller, and already 6 to 9 months in, we're 96% stabilized and executing our business plan. Winding Way is just a unique property. We had to let the property management company that was managing the asset go. They didn't really do right. So again, BlackSand back on task. We just took it over, so we got to dig our feet in and do the right thing, right? when it comes to managing the asset. So Henderson Place, that's just one of always our best performing assets. We're always smoking that market. We got huge competitors right next to us, and again, BlackSand had to take over that property from third party, which is why we exist. Just
Yeah,
be
that was our first property.
Yeah, it was literally why we created BlackSand, because we had like they were tanking the property, and BlackSand stepped in, and we've been able to operate this property very effectively and kick everybody's butt in the market. So very proud of Henderson. Midlothian Meadows is actually 95% occupied. This is again another case of BlackSand having to take over. So we just took over, I think, May.
Yeah, May 1st.
May 1st. So here we are 3 months in, and we took it from, I think it actually dropped lower than that. And we've taken it from there to 96% stabilized. Huge. That's one of our best managers out there. But again, BlackSand, our ability to implement and use technology, doing a 3 month, 6 month stability is very difficult. And to do it in 3 months, we're actually going to fly this property manager out to Hawaii. I just told Vincent, like, this is where we're putting this manager on a plane to Hawaii. Just really proud of her. She's so awesome. Ashton, this is the asset that we're actually fully converting to we did so well out here. Again, BlackSand, this was one of the other assets we took over. I think we took over in the 70s. They couldn't get it right. And then we implemented a new strategy where I was like, hey, Vince, what if I go buy 6 units of furniture and see if BlackSand can do a mid to short-term rental? We've been 100% occupied on those for 2 years. Average rent premiums above ProForma is like $600 to $800 a month per unit. So it did so well. We executed an entire business strategy to convert every unit. Right. And this is different. This is a different asset. This is community dense, so we can do such things. But yeah, just beautiful testament to how we're able to leverage our speed and change when we need to. And then lastly, Ensign is an asset that we just purchased. We are about 88%. And this is just a market that people have a tough time paying rent. A lot of lower income type people, and this is a brand new asset. So
Ennis.
I'm sorry. Ensign's the property. It's in Ennis. So yeah, so we're about 88, but still we're going to be executing short-term rentals, all the things to get occupancy up, just like the other ones.
It's great.
Yep. Here's a quick snapshot of the track record I mentioned earlier. So Barcelona would be our eighth full cycle deal, or sorry, eighth full cycle deal, 18th transaction as a team, multifamily transaction as a team. Our average hold time is 2.65 years. Our average equity multiple is 1.86. Our average AAR and IRR is 33% on our executed deals.
And Green Desert is one I mentioned earlier that Aaron and I were partnered with them as well on that one. So just the track record, looking at the IRR of these deals and the average annual return as well, compared to the ProForma we showed earlier. Now, like I started the slideshow with saying, there's no guarantee that these current investments will do as well as the past, but it's a good indication of the knowledge of the team and executing the business plan. So here's the investor experience. We have the cash flow portal. So if you've invested with us before previously on some other deals, you might have a portal login there. If not, reach out. We can help you get signed up. Reserve your shares. You'll create the investor account and enter your information on there to make sure we're SEC compliant. As I mentioned earlier, 506B offering. Please let us know if you're interested. Then you sign the subscription agreement and review them. You'll enter your bank account information in the portal as well, so that when we do get to number 6 and you start receiving distributions, you'll get them. Number 5, you will fund the investment via a wire or the ACH. Make sure before you send a wire, you give me a call or Aaron a call to confirm those numbers. We always like to do that to prevent wire fraud, just as another line of defense, which we're taught here as realtors in LA as well. And then after we purchase the property, You'll get monthly webinar updates, detailed financial reports every quarter. And then you will get your tax forms by March 31st for the previous year with that depreciation we were talking about. Also, like I mentioned, one of the things that we love about real estate investing is you can go and see the property. Like I said before, please let us know if you're going to be in Dallas and we can set you up with the team there to go walk the property or see it. That's something that we like doing. And I know Vince has brought his investors, and you get pride of ownership to say, you know what, we bought this and we had something to do with renovating it and providing a great place to live for people. So that's something that's been front of mind for Aaron and myself. We didn't touch on this call, but what we love about Vince and his team as well there, just the quality of the people running it, and the some of the what am I spacing on the name of it, but your business
Core values.
core values. Thanks for helping me out there.
Yeah, gotcha.
I know that's important for you guys as well, and to make the investors money, but also to provide a really clean, safe, good place for people to live is another reason why we enjoy doing this. So I wanted to bring that up before we sign off here. But yeah, if you guys have any questions, please reach out to Aaron or myself. Thank you so much for joining. Anything else you guys want to add before we log off here? I know it's been a good call with lots of information.
I know we've been looking at deals for a long time, and last year we only bought one. This year, this is the first one that's come across our desk that we feel incredibly strongly about. This is kind of the opportunity that we've been waiting for while we're underwriting deals and looking, and we're very excited about it. So I know if you have specific questions, just let us know, but we're very excited about this one.
Yeah, I should have mentioned that earlier, Aaron. We looked at 74 deals in Q2, and we went under contract on one. So it kind of shows the amount of deal flow we get, and we really cherry picking the very best opportunities. And this is also our first acquisition of the year too, because we've been waiting, as all watching all these distressed deals come. This is the first one that we were like really excited about because it's stabilized, because the story, the amount of money that the seller put into it, and the operation, being stabilized and everything. So 74 properties came across our desk in Q2, and this is the one we went after.
Perfect. All right.
That's great. Well, thanks so much, you guys.